Risk assets have experienced a strong start to the year due to brighter economic prospects and hopes generated by the new US administration in terms of reforms. The MSCI World is up in excess of 5.5% year-to-date as of early March, led in particular by the US market. In the meantime, the US dollar has regained its appreciation trend in February, in particular against the euro, the British pound and the Japanese yen, on the back of expectations that the Federal Reserve is on track to hike rates in the short term. The environment has proved supportive for hedge funds. The Lyxor Hedge Fund Index is up 1% in February, led in particular by CTAs and Event Driven managers. On a negative note, some fixed income managers underperformed as a result of their exposure, their sensitiveness to the rise in bond yields. CTAs outperformed in February other hedge fund strategies. The Lyxor CTA Broad Index is up 3.2% on the back of long positions on equities and long positions on commodities as well. Their exposure to the US equity market has been somewhat revised down, but remains sizable as of early March. Meanwhile, CTAs also benefited to their long exposure to the US dollar, in particular against the euro and the GBP. On a year-to-date basis, event-driven managers continue to outperform. They have recently increased their exposure to cyclical sectors such as financials, technology, and they maintain elevated exposures to the non-cyclical sectors such as healthcare. The outperformance of event-driven year-to-date has taken place amid solid M&A activity, in particular in the US. The largest deal announced year-to-date is the acquisition of Actelion by Johnson & Johnson, which ranks high in merger arbitrage portfolios. Going forward, we maintain an overweight stance on event-driven managers and CTAs. In particular, we think that the strong pace of M&A activity in the US should continue, and this should prove supportive for the strategy. We are still defensive on directional credit managers. We think that credit spreads are extremely tight and directional players should be exposed to the widening of credit spreads. Finally, on the long-short equity side, we have a preference for US long-short equity managers, which may benefit from higher stock dispersion in a context where the new US administration is implementing tax reform that should translate into higher dispersion across sectors and stocks in the US market.